Welcome, everybody. Good to see you this morning. Lee and I are primed and ready to get going here. Hopefully, everyone is doing well. Lots of stuff going on in the crypto world that we are very interested to talk about. But before we start, I wanted to introduce myself and Lee. So let's do that. And I think it's worthwhile kind of noting that. We both come from a little bit different directions in things. So I'm Jimmie Lenz. I run two of the graduate programs here at Duke's Engineering School, the Master of Engineering in Financial Technology and Master of Engineering in Cybersecurity. I come to academia from a couple of decades in traditional finance roles, running broker-dealers and chief risk officer and all kinds of fun things like that. And been here at Duke's, just starting my fourth year at Duke. And with that, I'm going to hand it off to Lee.
Good morning, everyone. So Lee Reiners here. I'm the policy director at the Duke Financial Economics Center. I'm also a lecturing fellow at Duke Law School. At Duke Law, I've been teaching courses on FinTech Law and Policy, Crypto Law and Policy for the past 6 years, and just heavily involved in various crypto policy debates, both behind the scenes and publicly. So always enjoy our little sparring sessions. Jimmie, although it's I'm gonna have to fight with one arm today to make it even here.
Yeah, I was gonna say you're gonna have to tie one hand behind your back.
Exactly. Yeah, because I fight fair. I fight fair. But no, good to be with everyone, and we got a lot to cover, and I think we want to also make sure people are aware of digital assets at Duke, our live audience and our YouTube audience. Jimmie, you got can we share the conference website?
We can. The conference website is really easy. It's digitalassetsatduke.org. So
Daniel
that is out there. Thank you, Daniel, for putting it out there. And we do encourage everyone to take a look at that and to attend. It will be in towards the end of January. We have a phenomenal lineup of speakers, and we are really excited to be a university that can host something like this. So with that, Lee, I know there were a couple of things that you and I had talked about. We don't script this, so people always wonder, how do you guys keep going? How do you keep talking about these things? It's like, we can do this for a long time. So we actually do not script anything. We do chat quite often. And so there were a couple of topics that seem to be on kind of on everybody's radar. And probably the first is the Brookings report that came out lately, and you had a number of comments in the public sphere on that. So I'll kind of toss it to you first, and then I'll give you my thoughts on.
Well, there's two Brookings things that I think you're referring to. So what you mentioned was the paper article that came out from Tenance and Carmona on crypto and financial inclusion. Encourage folks to check that out. I'll see if I can maybe find it and put it in the chat. Whether you agree or disagree, I think you'll find it informative. But I actually, Jimmie, had an opportunity to go to Brookings and sit on a panel 2 weeks ago. So we actually didn't have a coffee and crypto 2 weeks ago because I was in DC. And the occasion was a speech by the FDIC chairman, Marty Grunberg. And for folks watching, you're probably aware, but the Federal Deposit Insurance Corporation is the primary insurer of banks in the U.S. Well, they're the only insurer.
They're the only insurer. Yeah.
They're the only insurer. I think there is actually private. I think there are some
people. Yeah. You can get insurance above and beyond.
Yeah, so there are. But anyway, I digress. And they regulate. They share responsibility for regulating. Thank you, Daniel, for regulating banks. And so he gave some remarks on digital assets, cryptocurrency, and then got into some of the specifics around stable coins and had some recommendations. And I think we'll just kind of start maybe, Jimmie, with talking about banks' exposure to crypto, right? Because obviously the FDIC is not a regulator of crypto per se.
Right.
But of course, they regulate banks, and we are starting to see banks increasingly dip their toes into the crypto water, and it's been a long time coming. I mean, I think for obvious reasons, banks for a while were very hesitant to get involved in crypto. Of course, I think we're familiar with some of the remarks by Jamie Dimon around crypto. Um, and banks are heavily regulated. And I think there was a genuine concern around, okay, geez, I mean, if we get into crypto, what are the risks, the operational risks, the legal risk? Are we facilitating money laundering, things of that nature? And I think a lot of banks just also thought it was a passing fad too, and it would sort of go away. That tune has changed, and so now, like I said, you are starting to see banks. A few weeks ago, we had Bank of New York Mellon come out and say that they were going to start providing custody for
Mhm.
cryptocurrency for their institutional clients, and then in addition, providing the normal kind of range of custodial services, including accounting, reporting, things of that nature. So that was a pretty big deal. And there are other ways that banks are starting to get into crypto, but so far it's been primarily on the custody side.
Yep.
And so the question then, if you're a bank regulator, is, okay, how should we treat this? How should we address this? And, let's look ahead and think about other ways that banks might be getting exposure to crypto. And there are a whole host of ways, right? So we know we now have crypto derivatives. So are they making markets in crypto derivatives or facilitating those trades? Are they making loans with crypto as the underlying collateral? Obviously, we talked about custody. Are they facilitating stablecoin payments? Are they actually making markets in crypto itself and potentially holding crypto on balance sheet? I don't think there's much balance sheet exposure yet. But again, emphasis on yet. So I think regulators should be proactive here. And so and let's table the stablecoin part, because I
Yeah.
want to turn it over to you first. And so my stance on crypto, which is basically, listen, by and large, there's no there. This is entirely speculative. It's very risky. And I think, given the important role that banks play and how heavily regulated they are, it'd be prudent for regulators to draw some pretty firm, hard lines right now that would basically say banks are not allowed to hold crypto on their balance sheet. I think custody is one thing. And of course, we can get into custody of crypto looks very different than custody of traditional assets. But I do think regulators should be proactive. Let banks know that, hey, there are certain crypto activities that we just don't think you can engage in a safe and sound manner. But we'll see. I don't know where the bank regulators, and they have to be on the same page here, right? We have the Fed, the OCC, and the FDIC. I think they
All state
are. I
regulators.
think they are by and large when it comes to crypto. Um, they have all put out guidance at this point that says, hey, if you're a bank that we regulate and you want to engage in crypto activity, you first need to get express written permission from us to engage in this activity. So that's kind of where things are at now. But
Yeah.
there's some different, there's some other decisions that need to be made in terms of right? Like how much capital should you have to hold for these exposures, liquidity, things of that nature. So let me turn it over to you, Jimmie, and kind of get your thoughts. And also, there's also the irony here, right? Which is, crypto was premised on disintermediating the banks and being kind of anti-bank. And then now here we are, with a lot of people in the crypto industry sort of saying hooray for banks getting into crypto. So,
Well, I
anyway,
do. Yeah. No,
thoughts?
I think that is interesting because a lot of people are cheering that. But I mean, let's face it, banks have seen how much money is on the sidelines, and they're like, hey, we've been
Yeah.
losing out now for 5 years when things have really been robust. We want our cut of the pie too. So I do think BNY Mellon coming in as a custodian is a very significant first step. The fact they're doing it for institutions, I mean, that basically makes the onboarding, I think, reasonable, because if they said, oh, we're opening it up for everybody, they can't handle 10 million accounts in a year. That would have been impossible. So I think that's a way to kind of throttle that a little bit. But I do think it's a significant first step in that occurring. As far as looking to regulators to pioneer some kind of a way for innovation is fraught with problems. One, regulators never invented anything. They never created anything. They do pretty much everything in the rearview mirror, and there is no rearview mirror here. And so they're trying to make it up as they go along, and they figured out that they really can't. And so that's why they're not doing anything, in my mind. The argument around, BSA and AML and stuff like that is moot. There isn't one major bank in the world that hasn't been fined at least $100 million in the last 18 months for BSA AML problems. Hell, they can't even do information, right? What American banks alone just paid 1.8 billion for leaking information because they couldn't even follow information guidelines. So I mean, all the arguments that I hear about, well, crypto's bad, crypto facilitates all kinds of stuff. BS. It's a drop in the bucket. I mean, even the ransomware stuff, I saw people posting, well, they've facilitated 1.2 billion. Again, you can name any bank. They facilitated more than that themselves. They've been accused of facilitating an AML and BSA stuff. So that's just, those are drops in the bucket. They make for great headlines, but little substance there. I did want to go to the other Brookings report too, the one on inclusion.
Yeah, let's go there. But I'm gonna push
Okay,
back
push
though.
back.
I'm gonna push back because you're engaging in a bit of whataboutism, frankly. And so yes, is the legacy financial system and banks, being used to do bad things? Of course, right? But it's a matter of proportion. The banking sector and the financial sector is absolutely massive, much bigger than crypto. Obviously, we spend a lot of time talking about crypto, but we have to keep things in perspective here, right? I mean, crypto market cap is around
one. The growth trajectory of crypto is much more significant than any bank, sans
well, yeah, I mean,
Robinhood, right?
Yeah, well, yeah, I mean, so crypto's around 1 trillion, was 3 trillion a year ago. Anyway, so I think when you look at the proportion of crypto transactions that are used for illegal activity, it is significantly higher than the proportion of dollar transactions, for instance, right? So
I mean,
it's got, I mean, there's so much data.
I think there would be, I've never seen that. It would be interesting to go back and look at all of the allegations against traditional finance. It's actually something I'm going to look at. I'm going to try to look at that over the next couple of weeks.
Well, you got to look at it at a proportional basis.
Oh yeah, proportional to dollar transactions or something like that. Yeah.
And and the ransomware part, I mean, this is just kind of basic, it's just sort of common sense, right? I mean, before crypto, how many people were
there was still ransomware?
There was ransomware, but we weren't reading about it on the front page of the New York Times or the Wall Street Journal.
Yeah,
the reality is that when you're victimized by ransomware, they want one thing. They're not asking you for US dollars in a duffel bag. All right, they're asking you for a crypto. So crypto has made it a lot easier to facilitate criminal and illegal activity, and I would argue that it's its primary use case. I mean, otherwise it's just a speculative asset. It's not being used for payments. It's not being used for other things. So
no. I think that's incorrect. I mean, I think that's a line of reasoning a lot of people like to use. But remember that one of the fastest growing companies that is securitizing mortgages does it on a blockchain with cryptocurrency, right? That's Figure and Provenance. If you look in the last 5 or 10 years, new companies that are securitizing mortgages, they're probably number one. And they're doing mortgages and HELOCs, right? So first mortgages and second mortgages. This is probably the largest one there is, fastest growing for sure. And they facilitate it with crypto. It's their own crypto, but it's crypto nonetheless. So that kind of story. It's kind of like the narrative that I hear about, well, there's no solutions. Really, Maersk and IBM would tell you there's a solution. The Department of Defense would tell you there's a solution. I mean, there's example after example after example, and people say, well, those don't count. Why not? It's kind of like, well, yeah, but there's all these bad things. It's like, yeah, you see a lot of stories about bad things that are out there, right? And I remember, and I'm going to go back, and I know we've talked about this before a little bit, around the dot-com boom and those kinds of things. And the headlines were always, just do people really want to buy things over the internet? Those were the headlines when the 1999, 2000, when things were blowing up everywhere. all these .com stocks were going to zero, all these over-the-counter stocks going to zero. And people said, but this whole thing, this internet thing, do people really want to be purchasing stuff? And what does the internet become? It's become a giant shopping mall at the end of the day, right? I mean, Amazon, places like that. The other thing I would say about those times, and I have a lot of people say, well, it's not the same. And it's right. You know what? It's not the same. You know why? Because almost every one of those companies was basically sanctioned by the regulators. Those were all publicly traded stocks. Nobody ever really brings that up, but these were companies that were sanctioned. So maybe they don't want to get burned again. Maybe who knows what the story is there. But I've seen this play out before. The other thing that
but really it played out a lot faster. I mean, the internet and the .com. I mean, we're 13 years into crypto, Jimmie.
Well, okay, so it's 13 years since the paper was written and the first transaction was done on Bitcoin. I would say we're about 5 years in. 6 years in, for real, where you had a critical mass of involvement of wallets and different people and things like that. It has been 14 years since the paper was written, but like I say, for the first few years.
Oh, yeah, happy anniversary, by the way, Halloween.
That's a good one.
The Bitcoin white paper. It was Halloween 2008.
Yeah. And so, but it has been, a while, but until you reach that critical mass, I think it really doesn't, it really hasn't gotten going, but it has been a little while, and we are seeing use cases out there, I think, that are, that are pretty significant. I mean, heck, the Morgan Stanley thing that came out yesterday, right? Morgan Stanley doing DeFi transactions. On Polygon.
I think that was that Morgan Stanley or JP Morgan? JP Morgan. I'm sorry. Yeah, I saw the headline. I haven't had a chance to dive in. You want to maybe fill us in?
I mean, they did a DeFi transaction using Polygon. Daniel can put one of the stories up there. There's like 50 of them out there. So I guess when it comes to Jamie Dimon, look what I do, not what I say. And they also own Quorum, their own blockchain, right?
Sure.
And so there's a lot out there that is going on. So you are seeing more and more bank and traditional finance involvement in that space. And I swear it's just, they see all the money that's being made, and it's like, we want our piece of that pie. So I do think that, but I did want to.
You want to talk about the financial inclusion?
The financial inclusion one. The financial inclusion one. I'm shocked Brookings actually published something like that. It was very misleading. I think
how so?
I think on several levels, it was very misleading. I think that very first is they make this general statement about inclusion. Well, no, it's inclusion in the United States, and the definition of inclusion is the Reiners definition. And remember, the United States is less than 5% of the global population. So you're dealing with a subset of a subset of a subset to start with. So in academia, what we would normally call that is somebody forming a hypothesis and finding a subset of data to fit the hypothesis. All right. But even that doesn't fly with me, because if you look at, I would say, if you look across all ages, but specifically Gen Z and millennials, do they own more? Does a bit larger percentage have crypto or have 401ks or some kind of retirement account? Well, a lot more have crypto than have retirement accounts. So that's, if you wanted to paint this broad picture of financial inclusion, you'd have to say traditional financial institutions clearly are doing it very wrong. We better look for something else, because they haven't included anybody. I mean, in less than half of Gen Z people have a retirement account. And I've shown in previous research that millennials are actually more conservative in their savings habits, in their spending habits, than previous generations at the same age. So this is a more conservative group that has decided to go into crypto because they see, something there. Their I guess, level of risk aversion, or maybe their perception of risk, is different than others. And so they've decided to do that. But the fact that early on in this equation, they've gone heavier into that, a larger percentage have gone heavier into that than they have into retirement accounts, I think is very saying. So clearly, and as far as banking inclusion, if you look outside of the United States, and even if you look inside the United States, they said, well, some places have to have a bank account. Some of the currency exchanges have to have a bank account. but a lot of them just have to have a card. You don't have to have a bank account. You can just use a prepaid card to transact with them. And so I think that the report has like 50 holes in it. I don't know. I mean, it would never have made a peer-reviewed journal. That's for sure.
Well, it's, one, it's an article. I don't think
I get it, but it's posed up as.
I think you're frankly misrepresenting it, and I think it's fantastic. So I encourage folks to take a look. There's over like 80 sites in here. I mean, so one, Jimmie, she's not arguing that you're looking at financial inclusion in terms of just who has it, who has access to it, right?
Who actually has it, not
that's
who has
not
access
yeah.
to it,
So I mean, so
I'm looking at what's actually happened, not what may happen.
Well, I don't think so that's not how you look at financial inclusion, right? I mean, what is it accomplishing? So, okay, millennials have crypto disproportionately compared to like older folks, right? Minorities have more crypto than, so is it helping them, right? Is it providing some type of benefit, utility, what have you? And she starts off her article, and I want to get your thoughts on this, Jimmie, is there seems to be a disconnect or a cognitive dissonance between what crypto people are saying, because one thing that you hear a lot is, oh, well, this will, is easier to transact, right? It facilitates payments. And there's a lot of issues with our payment system. You and I have detailed, we agree on just how crazy the US's payment system and slow and antiquated it is. And then there's issues with cross-border remittances, right? And so, crypto is kind of billed as like the solution to these problems. So that's one kind of narrative from the industry about how crypto helps financial inclusion. The second is that it's a wealth building tool, that, crypto is an appreciating asset, therefore just, kind of historically, like housing, for instance, owning your house was a pathway to the middle class, crypto can be the same. The problem with those two is that they're in conflict with one another, because assets that are constantly appreciating are not very good as mediums of exchange, because why would you get rid of something if you think it's going to go up? So, I don't know let me stop there and see kind of like your thoughts. So it's one, setting aside if you have crypto, right? I don't look at having crypto as meaning anything in regards to financial inclusion, but how is it helping people that have crypto?
Yeah, so a lot of people are using crypto and simply using it almost like a savings account, an interest-bearing savings account.
It's been a pretty bad savings account over the last year.
It depends on the ones that you own. If you own stable coins, are worth the same thing they were a year ago, right? You can deposit those and earn interest on them, right? You can deposit those and earn a interest rate that's significantly higher than you would get at any bank, for sure, right? So I mean, banks are paying still what, 3 basis points or something. Even in using, conservative, some of the conservative cryptocurrencies, you're yielding, 3-4% on your assets. So it is a way to do that. I'm glad you brought up homes. People have been sold that bill of goods for a long time. Homes are, if anything, a terrible savings account. Nobody makes money on homes. Yeah, I've heard all the stories. If you look at the Case-Shiller index for 100 years, since the 1800s, the average home was appreciated 0. Yes, in the last few years, we had a run up. Okay, big deal. That's a few years out of the last century. But after you count for taxes and interest paid and maintenance, homes are a terrible. But in the United States, we've been sold that bill of goods. And we're also talking just about the United States. So we live here, we have this frame of mind, but we are a very, very small percentage of the global population. If you look at the global population, go ask people in Ukraine how much that meant to them being able to turn their currency into crypto overnight. It meant a lot, right? The countries with the largest percentage of people that own crypto are not the United States, shockingly. When people hit a crisis and you can't go down to a local bank and buy a stable currency, what do? You turn to crypto immediately. It's happened in South America in a couple of countries. It happened in Ukraine. It's happened in other places. People look to, in times of crisis, immediately, how can I lock in the value of my currency? That's how they do it. So looking at the United States, it's like we're a subset of a subset of a subset. Yeah, we do have a bank on every corner, but most countries aren't like this. There are continents that are not like this. So I think using us as a bellwether is totally incorrect. We are way, way, way out on the tail end of the curve for those kinds of things. And I do think about things in a global way because.
So what are you saying? So you're saying that crypto is used for payments? Like what, back to like my question, like what is crypto good for? You said savings account. It's better than a savings account.
You can definitely transact with crypto. I mean, I buy it. So you see me go and buy a coffee almost every morning. When you and I go have coffee, and what do I use? I use a debit account on my crypto account. I use a debit card.
That's different though.
Why is it different? I mean, it could be going to Bank of America or Wells Fargo, but it's not. It's going to a crypto account. So
it's being converted though to dollars. You're still using the legacy payment network. You're not actually, the merchant isn't taking possession of crypto.
Well, when I go to England and I buy something, not that I go to England very often, but when I go to England and I buy
now's
something,
the time. You should go now.
I know, I probably should. Start thinking about spring break. When I do that, the same thing happens, right? So I'm not paying, and I'm paying. He's receiving pound sterling, but I'm essentially paying. Well, I'm paying with crypto, but that's converted. So I mean, yeah, almost every time you do things, they're converted. But a lot of these countries are locking in the value and actually doing transactions in cryptocurrencies. Yeah, absolutely.
Well, I mean, her point is that when it comes to using crypto, right? I mean, so by and large, merchants aren't accepting crypto. Okay, so they might accept a Visa debit card, or whatever.
Yeah, but when I go to a food truck, most food trucks won't take cash from me either. They'll only use Square, right?
What does that have to do with the price of tea in China? What?
Well, it has a lot to do because you're saying this.
It's still denominated in dollars. The transactions you're doing are still denominated in dollars. Dollars are still the numeraire.
But what I'm saying is I can tie a debit card, just like I would tie a debit card to a regular bank account. I can tie it to a crypto account. I don't have Bitcoin that I'm sending them, but I also don't have dollars that I'm giving somebody either, right? It's all being facilitated through an electronic payment. And they can receive that payment in whatever they want. If I'm in, the UK, it would be pound sterling. If I was in, India, would be rupee. It would be whatever.
So they're still taking fiat currency, right? That's fine. But if, what is it going to take for people to actually accept crypto, like that street vendor that you mentioned, right? And her point was that, listen, you can send crypto across borders, maybe it's sufficient, but then you get hit with all the fees if you want to take it out into fiat currency, right? Because you need to have an account at an exchange, and we know that these exchanges charge very high fees. And so when you factor all of that in, it's actually worse than Western Union or what have you. Now, of course, if we ever got to a world where people are transacting in crypto or stable coins and keeping their wealth in that medium, then that's different, right? But I don't know what it's going to take to get there. Obviously, I'm skeptical that we ever will get there. But we still live in a fiat currency world, and that's kind of where crypto seems to be migrating, is that it's just maybe new technology, but still tied to the legacy fiat world. So am I wrong here?
Well, I know. I think that we are slowly transitioning to stable coins. I think we're seeing more and more of those used. I mean, honestly, if I want to go from crypto exchange to a different crypto exchange, do I turn things into US dollars? No, I turn things into a stable coin and move the stable coin. Yeah. I don't ever turn things into US dollars. So, I mean, if I'm just trading, I use stable coins all the time, right? And I would rather use those because they're a lot easier to move and change, and it facilitates a lot more things. The other thing I think is familiarity. That will be something that comes probably very slow to the United States because hell, we still have paper checks here. We will probably be at the end of the curve on a lot of these things, not at the beginning, which I think is it's a sad state of affairs that we are going to be at the end of it. When I think about some of the crypto like things that are being used now, like M-Pesa, Those are used in what, 20 countries now in Pesa?
A lot,
Which is
yeah.
basically cryptocurrency. You use it on your phone. You pay for things. You buy
It's
stuff.
not basically cryptocurrency. It's cryptography.
Pesa?
There's no It's mobile money. It's
It's mobile
e-money.
money.
It's
It's mobile
money.
money.
Yeah.
Okay, it's mobile money, but it's very similar.
How so?
But I can see that being used in a very similar way. Well, I mean, phones don't. I mean, right now you don't have a lot of phones that have wallets embedded in them. When you have more phones that have wallets embedded in them that can hold this kind of stuff, why I can see that. Absolutely. Why wouldn't people do that? Yeah, I mean that's really what sold M-Pesa was the fact that it's embedded in your phone. And it's really, really easy to use because of that. It's very, it's super simple. But I think central bank digital currencies, I think those will, help familiarity with this kind of thing. And I just don't think it's going to happen here in the US. I mean, we're already seeing it other places, right? Other places are starting to bring that on. I mean, one of our speakers at Digital Assets and Dad at Duke, Dad is the governor of the Central Bank of the Bahamas, right?
And the sand dollar.
And so he's going to be speaking about that at the conference in January. And I'm very anxious to hear about that. I would love to hear from some of the other folks that are either looking to do central bank digital currencies or that already have open invitation for people from China to come and talk about the digital renminbi.
Yeah. Well, you're hitting on, so the crypto community is not unified in some of these issues, Jimmie. So let's maybe talk about CBDC, because that seems to have kind of split a lot of folks. I mean, some folks view it as sort of a category killer, right? That, if everyone has access to digital risk-free money, right? I mean, that's the benefit of a central bank issuer, is that, they don't fail, right? I mean, I guess if the central bank fails, then you have bigger issues.
Yeah, bigger issues.
Then the government, then your whole government's failed. And so, why would we need all these cryptocurrencies and stable coins if we had CBDC? So you've actually seen a lot of prominent kind of crypto companies and voices say, hey, I don't think, and maybe it's self-serving, and maybe they just generally believe in the merits of their argument, but saying, listen, I don't think a CBDC is the way to go. And they've gotten some Republicans to kind of support them. So actually Congressman Tom Emmer from my home state of Minnesota has introduced a bill that would ban the Fed from issuing a retail CBDC. So what is your take here, Jimmie, on the utility of CBDC and where the US and maybe other jurisdictions are heading here? What does that mean for other cryptocurrencies?
Yeah, so I think that a couple of things. I think that if you are looking at other kinds of cryptocurrencies, they do facilitate other things that CBDCs don't. So a lot of DeFi protocols are not going to work with CBDCs. People just won't use them. And there are a couple of reasons for that. There are only so many things that you can do with a US dollar. You can't do smart contracts and things like that. So that will be a hugely, that will limit the use. I still think that the familiarity will be helpful to the whole industry and that whole ecosystem, but I don't think that it will overrun the ecosystem. I don't think that it will be just that. With all of these really large networks that we have out there right now, I mean, they're not going to be dominated. If I want to do something on the Ethereum network, they're not going to let me pay with a digital dollar, right? You're going to pay with the currency of the realm, and that's,
well, there's a settlement. I mean, each blockchain has its own settlement asset. In Ethereum, it's Ether, right? So yeah.
And so anything that you want to do in those kinds of spaces, anything that you want to do with smart contracts are not going to be facilitated. So they can certainly, I think there's a place for them, but it's not, it's not that it's not binary. It's CBDCs, and there will be no rest of the world. There will be a place for them, but it won't be the only place.
Yeah. So you're okay. So you're saying that there's a world for both here.
Yeah, absolutely.
Well, let's talk about stable coins, because this was another issue that Chair Grunberg discussed. And going back to a year ago, the President's Working Group on Financial Markets issued a report on stable coins. And the PWG, for those who aren't aware, consists of the Treasury Secretary, the SEC Chair, the CFTC Chair, and then in this instance, they were joined by the head of the Office of the Comptroller of the Currency, the FDIC, and then I think the Fed is a normal participant too.
Right.
And they looked at some of the current issues around stable coins and where stable coins might be heading, and they acknowledged that present reality with stable coins is that they're basically used to speculate in crypto, right? So unbanked exchanges overseas, it's easier, as you mentioned, right? Like when you go from exchange to exchange, stable coins are easier. And then DeFi, right? So, most people, because DeFi is all about over collateralization, you want a stable asset to over collateralize so you don't get automatically liquidated, and stable coins are great for that function. So that's how they're used now. But the report says, well, maybe there's a future in which stablecoins are actually used as a medium of exchange. And in that future, barring any changes, there's a real risk of a bank type of run, right? That folks that use a stable coin might be concerned that the quality and the composition of the reserves backing that stable coin is insufficient to meet redemptions, and so then it feeds on itself, right? Think of if you watch It's a Wonderful Life and they're all lining up outside the Bailey Brothers building,
Yeah.
Bailey Brothers building and loan, trying to get their money out, so you could have a digital equivalent of that. So that's the concern. And what's the solution? So the solution, in their eyes, is to require stablecoin issuers to become FDIC insured banks, right, and avail them, and then be subject to supervision, and they'd have access to the federal, the safety net, in terms of Fed lender of last resort facilities, and this would kind of instill confidence and prevent bank runs, and this is something that Chair Grunberg spoke about, and he kind of offered a little more specifics. He actually says that stablecoins should be issued on permissioned blockchains only. So I've gone back and forth, and I'm actually working on a piece now, a little teaser for folks that I'm trying to place in a major newspaper that basically says this is kind of a misguided approach here to stablecoins, that we actually don't need to bring them into the banking system, and if we do that, we're only increasing risk to the banking system, and we're going to, turbocharge DeFi, which is in effect a new form of shadow banking system outside of any regulatory purview or control. And that really, these concerns around a run are overblown. Just look at the situation with Tether, right? I mean, there have been issues and questions around Tether's reserves since there's been Tether, and how many times have they promised an audit and haven't delivered, or they're fired their auditor? And yet Tether has been remarkably stable. I mean, there have been a few periods of time where it did break the buck by a little bit, and then it came back. And I think this points to the reality that stablecoins are stable because crypto traders need them to be. Therefore, they act as though they are. And so I really think if you just have disclosure, timely disclosure around the quality and the composition of reserves, that kind of solves the problem, right? The market will sort of be the market is a disciplining mechanism. Right, and then stablecoin investors will then decide, okay, I think this stablecoin is better run and better governed. So, I'm kind of pushing back here on the preferred regulatory solution. Of course, if you're a prudential regulator, you think about prudential regulation of everything, right? So, what are your thoughts here, Jimmie? I mean,
this is one for the decades. Lee and I agree.
All right.
I agree with you on this one. I personally see stable coins and guidelines around stable coins much more similar to money market funds. I mean, money market funds are certainly guidelines, and there are some rules around where they can go as far as maturities and things like that. But I definitely see stable coins in the same kind of that same realm as a money market fund, right? Those aren't banks; they're not regulated as banks. They hold just a ton of deposits, right? They are a cash sweep option for a lot of brokerage firms out there, a lot of brokerage accounts out there. They are very liquid. And so I can easily see that being more of the tack that they take, and they're used kind of in the same way, right? As money market funds. And so I'm a believer that these are not deposit taking institutions in the same way, because what they're actually doing is investing the money immediately. And they have to, right? I mean, they don't want to hold cash of any kind, whether it's in crypto or in USD. They don't want to hold that. They want to invest it immediately so that they can lock in the value. And so I think that there's no basis for those to be regulated by any of the provincial regulators. I know that they love to increase the size of their kingdoms, but
Exactly.
this is not the place to do it.
Well, and but when you bring up the money market fund analogy, of course, the retort is, hey, the Fed has had to backstop money market funds twice in the past 12 years, right? First in 2008, and then again during the onset of the pandemic in March of 2020. And I think you and I will probably also agree on this as well. One, money market funds are just a lot bigger than stable coins, so they're more kind of important to the
Right.
economy. But the reason that we, the government bailed out money funds, was because money funds hold a lot of commercial paper.
Yep.
And commercial paper is issued by all sorts of companies to really, fund their day-to-day operations, right? That's kind of what the purpose of commercial paper is. And so the concern is that if you let these money market funds fail, or there's a run on money market funds, they're going to have to, engage in a fire sale of commercial paper to meet these outflows. That's going to decrease the prices of the commercial paper. Of course, prices and yield are inversely related. So
Sure.
borrowing costs for companies in the real economy would go up. And so I just think that concern isn't applicable when you look at stablecoins right now, because a lot of them are migrating. And I think Daniel put in the chat, Tether announced that I think they're eliminating commercial paper from their reserves. Right. You look at US Circle, USDC, the second largest stablecoin, they're very transparent about their reserves. You can go online, they do, I think, monthly. Yep. And they even have it to so it's all bank deposits or treasuries.
Treasuries.
And they
treasuries.
And they even have QSIP on the. So I don't really think that there would be this kind of, the market could have sort of absorbed, any type of, sales that these stable coins had, because you're talking about treasuries, and deposits.
And even
so I just don't think the money fund analogy is appropriate. I mean, like it's appropriate in how they're used. Like I get what you're saying, but like the
how they're used and how they're invested.
Yeah, but the risks are different, I think.
The risks are a little bit different, because people do use these, traders are using these, and so there is an inherent interest to keep these solid, keep them at a buck. But I think the fact that they invest in basically the same things, less commercial paper, more short dated treasuries and those kinds of things, is a little bit different. And let's face it, when the Fed had to step in to money market funds, they were basically just giving them liquidity early. It's not like they were really bailing them out; they were just giving them liquidity early for things. So I don't see that like they bailed out other companies. It was just simply an early liquidity event more than anything else. But I do see an analogy in the way they're managed. I do see an analogy in the way they're invested. No, they're certainly not as large right now. They're not as germane to the population. Could they be at some point? I think that it's possible that they could be an alternative. I mean, but it's certainly, they're not banks. We agree.
Yeah. So you would agree that, hey, provided that they're transparent about the composition of their reserves, and there's maybe some restrictions on what they're able to invest those reserves in, they don't have to become banks.
Absolutely.
Yeah,
absolutely.
I think that's the right approach too.
Yeah.
Well, listen, let's change gears because I don't know if you know this, but we got an election coming up.
I heard about that.
I don't. You can't. I'm getting all these texts. I don't know. That's.
I've gotten a lot of texts. It's like, how'd you get my number?
Exactly. They got to crack down on this, man. Yes. So I've been replying stop to a dozen texts a day recently. It feels like. So of course, we're not going to talk all things election related, right. But elections have consequences, as they say, and certainly they would probably have consequences on fintech and crypto.
Yeah.
And there's been, we've talked many times on these chats about various regulatory proposals for crypto. And I think some of these will get a little momentum behind them depending on the outcome of the election. So let's just sort of do a little prognosticating here. We'll do a little CNN panel, pundit panel here. So I think listen, Republicans by and large are more pro crypto than Democrats, and Democrats seem to be split. But I think Republicans are fairly united. So if Republicans, if there is the red wave and they take back both the House and the Senate, I do think you're going to see some movement on, various crypto bills. I think first, the Senate Ag Bill, the Digital Commodities Consumer Protection Act, which would give the CFTC oversight over crypto spot markets. I think, there's a real chance that that would pass the Senate, and there is some Democrats that do support that, which of course would ease that path. And this is something that, supported by and large by the crypto industry, right? Because, as we talked about before, crypto spot markets are, entirely unregulated at the federal level. And the CFTC seems to be the preferred regulator of the industry. So I think you'll see, you would see that at least pass the Senate, and then it would go to the House. And I think there's support there for the House. I think maybe something on stable coins, despite what we just said, there does seem to be some bipartisan consensus that, hey, there should be some type of, regime where stablecoin issuers do have to become banks, or at least subject to some form of bank-like regulation.
Right.
You could see something there. And I think those are really the two issues. As I mentioned, CBDC, I mean, Republicans kind of seem to be opposed simply because their crypto donors are opposed to it.
Right.
And so that, but I don't know what or what thoughts you have here. But if it's split, if the Democrats retain, I mean, it looks like the Republicans will probably take out the House. If the Democrats retain the Senate, that's obviously going to make things harder. And then, of course, the question is, no matter what gets passed from both chambers, would President Biden sign anything? And that to me is the real wild card, because this administration, it's like they have suffered from multiple personality disorder when it comes to various crypto things. So I don't know.
You can just stop at multiple personality disorder.
Yeah. So anyway, but that's kind of that's the lay of the landscape as I see it when it comes to crypto.
Yeah, no, I don't see, honestly, regardless of what happens, I don't think anything's going to happen quickly. I think probably the only thing that will move forward would be something around spot markets. And I think some of the things that have been floated, I mean, because those are opportunities too, right? The question is, around spot markets, though, is what is the spot market? There is, and I would hate for legislators to decide on this. I think this is in the realm of either industry or academia to define this a little bit better. I mean, for those of you who don't realize it, there is a Bitcoin future. It's actually, they take the amalgam of 6 different exchanges. So there is no spot price. It's a derived spot price. Maybe that's correct, maybe it's not. But I think that, for an asset class that trades 24 hours a day, 7 days a week, every day of the year, this is something we've never seen before. And so having a spot market means you have an opening price and a closing price. What time is that? For something that trades very liquidly 24/7. Now, people say there are other assets that trade 24/7, currencies, for instance, but they're actually very cyclical. And pretty much all of us know tomorrow at 4 a.m. what the flow is going to look like. Cryptocurrency is not like that. It does trade in a very liquid fashion around the clock. So that making those kinds of decisions on a spot market, I don't think those can be happenstance. I think that has to be done in a really, really thoughtful and logical manner, because once you do this, then what happens? Well, the big problem with, that the SEC has had with okaying some kind of future or some kind of funds is around, well, there's no spot market. So there's no pricing. So we can't do this because there's no opening and closing price. Well, now you've somehow, created this opening closing price in a spot market. You will see a lot of funds being floated, and that the excuse they've used in the past will no longer exist. Whether that's the right call or not is different. And I would hate to have legislators be the one to decide what that is, because I don't think, one, there's very many that are knowledgeable. I mean, I don't know how many you've talked to. I know how many I've talked to, and it's a small handful. I don't know that they understand all the intricacies, And honestly, I don't think they really understand economics in a trading fashion very well for the most part. And so, there are a few scientists and fewer traders that are in Congress. And so I do think that's, that's problematic doing that. But I think that's the only thing I see moving forward. I think that the other one thing that may happen is you may see more bank involvement in crypto if Republicans take control of both the House and Senate. If it's not the House and Senate, it won't happen. But if it's the House and Senate, there may be a little bit more, and it may be, definitely more custody, but, possibly some things on the institutional side. I don't think it's going to be on the retail side. On the institutional, I would say, possibly the ability to do some cross collateralization and things like that are, really only benefit like prime brokers and, things along those lines, but still relegated probably to the institutional side of things.
Yeah, I mean, excellent points. And, in regards to the spot market, there also seems to be a fissure that's formed recently here within the crypto community around how should any bill that addresses crypto spot market apply or not apply to DeFi. And, I think maybe we should just have like a DeFi only coffee and crypto, so we can maybe tease DeFi for the next time here.
We could do that.
But I'm sure you saw, Jimmie, but there was a little bit of a spat between Sam Bankman-Fried and Eric Voorhees. And Eric Voorhees is a pretty outspoken and well-known sort of crypto libertarian. SBF, arguably the most famous person, I guess, in crypto, and CEO and founder of the FTX crypto exchange. And SBF,
one of the top 10 crypto voices of 2022.
Shout out to Jimmie Lenz, who was join him on that list. So that was whose list was that? That was who put out that list, Jimmie? Top 10 crypto voices.
In fact, I'll see if I can. Well, Daniel can find it.
Daniel can find it. Put out the top 10. So Jimmie and Sam and other well-known crypto folks were top 10 crypto. They didn't have crypto skeptics. That's why I wasn't on there. But anyway, so Sam kind of floated some, I thought, sensible ideas that generated a lot of backlash within the crypto community, because a lot of folks within crypto still adhere to kind of the origins of the Satoshi white paper and libertarianism, which says, hey, this is designed to be outside of kind of government control. Code is law and software is free speech. And things like that. And so, it's one thing to say, okay, intermediaries should be regulated because that's how financial regulation traditionally is conducted. But what if it's truly decentralized, right? What if there is no one person? We gotta mute. There we go. So what do you do, right? What do you do when there is actually no central intermediary that is critical to the functioning of the protocol, the service, whatever you want to call it. And so maybe that's a good note to end on, and we'll tease kind of, maybe what should or could we do about DeFi?
Yeah, no, so I think, I think people have to think, why does DeFi exist? Why does DeFi exist? And
to gamble.
I would make
that one's easy.
Yeah, I would make the argument that, okay, even if it's to gamble, I wouldn't put it quite that way, but I would say, it's funny. I was talking to one of our postdocs here this morning. We were talking about the equity market here in the United States over the last 2 years, and it violates every rule of fundamental and technical analysis. It's basically a roulette wheel, the equity market in the United States. So if you want to say that about DeFi, yeah, maybe. I wouldn't say that. I would say it's a little bit different than that. But what I would say is, why are people going there? It's harder. The user interfaces are terrible. Why are people taking all the pains to go to DeFi? Because they can't get it any other place. They're able to buy into things, yield some, and most of them, honestly, the vast majority of things in the DeFi space are only yield-bearing accounts. They are nothing more. They're savings accounts, basically. With better rates of return. That's massive part of DeFi are those kinds of things. Yes, there are some swaptions. Yes, there are swaps. Yes, there are some derivatives and things like that. But the vast majority of people are just depositing money. So they're just borrowing and lending, basically, protocols that pay a little bit better rate of return. And why are they doing that? Because they can't get them. I mean, let's face it, if you could get it at some place that was a traditional financial place, it has a little bit better user interface, that's a little bit smoother to use, you'd probably do that. All right. I mean, consumers tend to go to what's easiest to use. These are not easy to use, and people are still going there. And you have to ask the question, why? And this isn't like, a few 100,000 people. This is like millions upon millions of people that are doing this. Why? Because they can't get it any other place. These are products that they should have access to anyway, and they don't have access to. And I know we're hitting the end of our time, but I agree with you. Let's do one on DeFi. Let's do our next podcast. Let's do strictly DeFi. We will do, and coffee and crypto will be coffee and DeFi.
That's right. And I can talk about UkiDAO.
And you can talk about UkiDAO.
All right, Jimmie. Well, it's a pleasure as always.
Always. It's always fun, and it's great. Everybody, don't forget, we will be having digital assets at Duke in January 20th and 21st here on the Duke campus. Would love to see everyone here. And with that, have a good afternoon, everybody.
Namaste.